All right, so, when I accepted the invitation to come down and talk, I was very pleased because I was going to get to talk about the 5 localized debt markets across the region that have really been driving development. Stronger currencies, a lower trajectory of inflation. It really did look to me as if, Latin America was on the cusp of making a turn for the better. More investment, modernization over the medium to long term. Unfortunately, on February 28th, the war in the Middle East has caused energy markets to roil the global economy. So, like the IMF, we all have these reference forecasts that we're making, which really is a way of saying, well, this is what we think is happening, but we have a lot less confidence, simply because the energy channel is going to cause inflation to increase and a real income, in some cases, like in the United States, to now fall. So there's going to be less demand for all sorts of exports. Costa Rica, obviously, even though it's modernized and it's now a tech and service hub, agriculture still plays a very big role. And your exports to the major trading partners here in the region and the hemisphere, they likely will be a little bit weaker. But my sense is that the underlying condition of Latin America, because of the big oil exporters, Brazil, Colombia, Ecuador, Mexico, right? It's actually going to benefit. In what I've observed in the first 3 months of the war is that rising commodity prices, rising oil prices, and specifically rising copper prices, have provided a cushion for the economy. So I'm only expecting a modest deceleration in growth. For example, prior to the outbreak of the war here in Costa Rica, GDP was up 0.3% in the quarter. That translates to about 4.1% year over year. I only expect a very modest deceleration in growth, probably 3.5 to 3.7% on a year-ago basis. Now, why is that? Well, it's because Costa Rica is going to swing from a year-long bout of disinflation or deflation to inflation probably near 3.5% by the end of the year. And that's simply because of the rising cost of oil, refined products, and other sorts of energy products. And so that's, I think, a good picture of where we're at 90 days into what's going to turn to be a historic global supply shock, specifically driven by the cost of oil and refined energy products. So when you have these sort of oil shocks, central banks tend to act in ways that impact the economy in a greater way than the actual price of oil. My sense is with the Costa Rican central bank, because of the period of deflation, it can actually look through the initial supply shock, let the inflation rise back towards target, because I think an unnecessary rate hike in the near term would damage the economic prospects of the economy. Perhaps more importantly, when we have these supply shocks, central banks need to also watch what's going on with the currency. Now, one of the interesting things about this is that the U.S. currency, if you look at the Bloomberg Dollar Spot Index, is only up about 1.5%. Now, it was up much stronger earlier in the conflict, but it's eased back because there's real concern today about the rate of inflation in the United States and whether the United States is on a sustainable fiscal path. Mm-hmm. So this morning, we actually have rates rising at the long end, even though the price of oil is falling. Now, if you're at the Costa Rican Central Bank and you're looking at this, you're thinking, you know what? I think my best move is to do nothing. Reinforce the credibility of the bank, talk about you're monitoring it closely, but let the colon weaken a bit. That way it will help cushion the shock that's clearly in train. Now, when you're a non-oil exporter, you have to be very careful. So what I would sense is you're going to get the best of both worlds. Central banks who are going to sound hawkish, but they're going to act dovish. And this is important, right? typically when you see interest rates in the United States go up, that's a bad sign for emerging markets because capital flows go back to the United States. But this time, the reason why interest rates are going up is not because of a strong, hyper-strong economy. It's because there's real concern about inflation and the fiscal spending on the part of the United States government. So this requires a more nuanced policy approach on the part of both central bankers and the fiscal authority inside the Costa Rican government. Okay, so the U.S., we think, well, right after the war started, we modeled the oil shock that we thought was occurring on the U.S. economy. And within 2 weeks, we downwardly revised our forecast from 2.4% year-over-year growth to 1.7%. We upgraded our estimate of a recession from 20% to 30% over the next 12 months. So we don't think the U.S. economy is going to go into a recession, but we do think that growth is going to slow, primarily due to demand for goods on the part of the middle class, the working class, and the working poor inside the United States, experiencing a decline in their inflation-adjusted wages. Now, when we talk about the American economy these days, much like our good friends and family here in Latin America, we've got a problem with inequality. We have a K-shaped economy or a split-screen economy. The upper two quintiles, the 40% of households, the upper one, the ones who are well off, they're responsible for close to 70% of all spending. And they are actually experiencing quite the tailwind right now. There's been large tax cuts. The U.S. equity markets have gone parabolic due to the introduction of artificial intelligence into the provision of goods or production of goods and provision of services. So the U.S. economy is going to cruise along for at least a while on the back of those very strong currents.
Okay.
Now, what's happening inside what we call non-residential investment in the United States as artificial intelligence centers are being built out is a once-in-a-lifetime experience. Over the two-year run rate for 2025 and 2026, in terms of investment, will be around $1.6 trillion invested into this new, undiscovered terrain of global economics. I think over the 5 years, looking forward, you're talking $4.5 to $5 trillion just invested in this to build out a whole new economy. So the U.S. is moving in a different way. Right? If one has exposure to that, if one's, say, producing helium, bromide, or sulfur, and can export into the production of advanced microelectronic circuitry, you're going to do very well, right? So when we talk about the American economy, we have to say something is happening that's altogether different, that doesn't have any precedent, that we think is going to go on for a good period of time. Okay, what that means is the American economy is a $30 trillion dynamic and resilient beast that's been able to absorb the initial 90-day shock of the war and the jump in oil prices. It's almost as if nothing's happened. People are upset. They're paying a lot more for petroleum, right? But it doesn't seem to have caused anything to stop. The U.S. economy grew at 2% in the first quarter of the year. And so that's in between our original forecast and where we think it's going. So the Western Hemisphere, because the United States, now Venezuela, Brazil, Colombia, have all stepped up oil production. The hemisphere is absorbing the shock caused by the war, and not in an unexpected way, but in a very impressive fashion. And this is why, yes, things may get tough, especially in smaller countries, smaller economies. But we think it's largely going to move ahead in a way that you won't observe in Asia, the Indian subcontinent, and parts of Europe. Well, this is when, Costa Rica is going to have to move in an efficient, forthright, confident manner. Because it's not just going to be demand for commodities as the US repatriates some manufacturing, but builds out its own AI infrastructure. Going forward, you're likely to see Mexico come forward with demand for a second modernization of its economy. This is something that's not really talked about enough in the hemisphere, or even amongst the three large North American economies. Yes, Mexico's had a downgrade to its credit rating. It's going to be more expensive, but they're going to reconstitute their infrastructure because they haven't really maintained and created the necessary level of investment to drive that economy in the way that it's capable. So a place like Costa Rica is well positioned to do well, but it too will need to make sure that it's open for business, for global investment. And that means, making sure you don't overshoot the inflation target. That's making sure the colon remains strong and flexible, and the national government doesn't overdo it with its own spending. If those three things can be met, I'm fairly confident Costa Rica is going to do quite well here in the next several years. Simply because I can't think of a time when we've had both Mexico and Canada, when we've had Canada, Mexico, and the US driving their own investment based on domestic needs. So things are going to be a bit better than I think people think. And like I said at the outset, I was very pleased to accept the invitation to come in here and speak at the RSM Latin American event, simply because, you think about the 5 localized debt markets, right? You get Brazil, Chile, Colombia, Mexico, and Peru. That didn't exist 20 years ago, right? And that's going to drive growth in those economies, the big ones, and then it will spill over into the neighbors and the trade partners. And that's a good thing. Now, what I think is likely to happen is once we get into the post-war period, the dollar is going to depreciate in a notable way. Now, that will help on the margin, especially with inflationary pressures, because I expect the price of oil to remain between $90 and $110 a barrel going forward for some time. So this is going to be very different because, my primary emphasis is on the North American economies, specifically the United States and the G7, right? Typically, when you see interest rates going up, you would expect capital to be flowing in the United States. So, but this time, I'm not expecting that.
Okay, interesting.
Yeah, the dollar's going to be weaker. So this is one of these times where you're going to get a U.S. economy that grows, and Latin America is going to benefit from it, not live in fear of a financial and banking crisis. Well, I mean, the international institutions think of Costa Rica as a high-income economy. I tend to agree, although it does have its inequality problems, like all of the economies in the hemisphere do. When you're growing at 4% and you've got 0% inflation, that's a good working definition of an economy that's on the move.
Yeah.
It should be confident.
It's in real terms.
That's right. That's right. Yeah, and so things are going quite well. Okay, so there's two big things, and one is that as we enter the second 90-day period of the war, we will reach a point in June 1st where there's going to be some operational stress in global energy markets, and we could see another round of increases in oil and refined products. And we want to watch that closely. Should the war not be wrapped up by the fall, we'll reach an operational floor where there will be shortages around the world, especially in the smaller non-oil exporting economies. So businessmen want to remain conservative around their outlook. They need to make sure that they're increasing efficiencies inside their operations. They really do have to get in touch with the role of energy and demand for goods that they produce or the services they provide. Because, like I said, we all have reference forecasts. But we do know that about 10 million barrels a day has been removed from the global economy, over a billion barrels. And at a certain point, if refineries are focusing on providing jet fuel to support the aviation industry, that means there's less opportunity to produce something called naphtha, which feeds into the production of plastics, which then feeds through down to food prices, right? Because we go to the store and we buy our food typically in plastic, right? Okay, so this is part one of the war is just about to be over, and the second act is going to start. So there are real risks around the outlook on that. Okay, second thing is it's important that even smaller businessmen in places like Costa Rica embrace the improvement in technology that's occurring due to artificial intelligence. Artificial intelligence is a transformative yet disruptive technology. Perhaps one way to think about it is that the sign of a fine-textured mind is the ability to take two simultaneously contrasting ideas and arrive at synthesis. And that businessmen are going to have to face this challenge. This is going to be the management challenge of the next several years, is that the integration of AI into the production of goods and provision of services is going to alter the fundamental underlying structure of the global, the regional, our hemispheric economy, and even the Costa Rican economy in ways that maybe people don't quite understand yet, but they're going to have to come to embrace and learn to manage.
It's like when internet starts.
A little bit. This is somewhat different.
Yeah,
right?
Because it's faster.
It's much faster, it's interactive, and it can provide guidance in some cases.
Yeah.
I have a Bloomberg terminal on my phone,
Okay.
and they have an AI agent. It's called Ask B.
Yeah, I see.
And I can ask it to do very sophisticated things that you would have needed to have a PhD in economics or finance or mathematics to do just a short period of time ago. My team is very efficient. We're almost lethal what we can do with the artificial intelligence at RSM in North America these days. And I'm a firm believer that this is going to create the conditions for improved revenues and improved profits. The risk is that smaller firms wait until it's too late. And I think that's a good takeaway.
Yeah.
To think about what's going on, X the war, X the risks around the energy channel. Invest in what it is you understand. Invest in what it is you can measure. While the outsized returns inside AI are attractive, you have to have a fairly high risk tolerance and be willing to tolerate significant volatility. You know, for all of the talk about deglobalization, it really just hasn't happened. Global trade has continued even though US and China tussle on all sorts of issues, even though the US has erected trade barriers and tariffs. Based on the regional development of localized debt markets, I think it's time to invest in yourself.
Yeah.
All right? Thank you. That was great.
Perfect. Thank you very much.